Hello, everyone, and welcome to session 6 of the massive open online course for the master's degree in digital currencies by the University of Nicosia. This is Andreas Antonopoulos, and I'll be answering the questions you had from last week, as well as any other questions you might have live. If you have a question, please ask it on the YouTube comments, and we will be answering those live. So this session 6, is about alternative uses of the blockchain, secondary layer, non-financial uses, colored coins, counterparty, Omni, and the Lightning Network. First question comes from Gustavo. Looking at the Coin Prism website, they say that colored coins can be used to store and exchange dollars, euros, or pounds anonymously across the world and for the price of a standard Bitcoin transaction. Gustavo asks, how can this be possible? They would need a bank or other entity to keep the assets, and the colored coins would be a digital representation of the stored assets? Precisely, yes. Essentially, what the colored coins act as is certificates of ownership, backed by, presumably, these assets being held in reserve in some bank account. It's an idea that hasn't really taken off. And part of the reason it hasn't taken off is because by holding assets in reserve, that introduces counterparty risk. So you're not actually holding the asset, you're holding a certificate of the asset, and the asset is in reserve. That's different from other uses of colored coins. For example, if you have a legally binding agreement and you issue shares of a company on colored coins, then the colored coin is the share of the company, and if that's something that you can enforce legally, then you can trade it directly. But with currency, fiat currency backed by reserves, that's not so easy. So you may have some counterparty risks there. Gustavo asks, what is a pre-mine, insta-mine, and ninja mine? How can a developer team of a new altcoin benefit from a pre-mine? This is probably a question better for the next section, but let me clarify. A pre-mine is when the development team deliberately mines the coins in a private network before releasing it to the public. So taking advantage of the low difficulty, they run the mining algorithm for a while in an environment where they control how much hashing power goes in. Which means that since there's no other miners joining, the difficulty remains stable and low, and mining can proceed at a very rapid pace. Many coins can be mined in advance. And then when it becomes public, usually the difficulty rises quickly. But in the meantime, the development team or whoever is doing the pre-mine already controls a significant part of the coins. An insta-mine is when either the algorithm is tweaked or the software is run in such a way as to make the difficulty 0 and mine a lot of coins either in the Genesis block itself or in the very first few blocks, and essentially spend no time mining at all, just immediately pre-mine a big chunk of coins. I don't know what a ninja mine is, but I'm assuming it's some kind of stealthy type of pre-mine. Because pre-mining has been considered by many to be a red flag, an indication that an altcoin is primarily driven by profit motives and not useful differentiation, I would expect that some organizations are reluctant to pre-mine in a very obvious way, and so they may be trying to do that in a very stealthy way. And I would expect that the term ninja mine refers to that. Svetlana asks, I'm a bit perplexed with colored coins' value over time. Let's say a colored coin now represents a share of Alice's company. Shares of Alice's company can increase and decrease in terms of their market value with time, but yet they will always be based on the current price of Bitcoin, as there are still Bitcoin with additional hashtag, and they can't grow and drop in price independently from Bitcoin. Or can they? And their cost will be Bitcoin cost plus cost of the share itself. Svetlana, you got it in the second part of your question. Yes, they are traded independently and priced independently as shares of that company, not as the underlying Bitcoin value. The whole intention of colored coins is that the underlying Bitcoin value is minuscule, infinitesimal, tiny, and irrelevant in the big picture. It's like stamping on a single dollar bill, this is an IBM certificate, a stock. And as long as the certificate or stock is worth significantly more than $1, then the value of that dollar is really irrelevant to the discussion, because it's far more valuable as a certificate of stock. Now, in the case of colored coins, the amount you're spending to issue the colored coins is a transaction fee. The outputs themselves are at the dust limit, so 5,400 satoshis or so. And that means they have very, very low value, almost none at all. And yes, there are some costs to make transactions and transfer colored coins, because you have to do Bitcoin transactions. So there are transaction fees that you have to fund. But the cost of the colored coin, or the value of the colored coin in Bitcoin, is close enough to zero that you can just say it's zero, at least for a very long time. Now, in the meantime, presumably the value of Alice's stock is not zero, is much greater. And therefore, the colored coins will be traded because of their value in Alice's company as stock. And they'll be traded on markets as stock for that company. And therefore, they acquire value separate. Again, we haven't seen too many successful implementations of that yet. But that's the general idea. Roland asks, I was wondering who stores the data files in the Factom data layer, the individual users, and thus no backup on the Factom network, the nodes, and thus a lot of bandwidth needed to store all of this data, or only the miners, meaning less backup of the data. Isn't this a very inefficient way to do data storage? I'm not actually sure what technique Factom uses. We've seen a number of different techniques. In some cases, as you said, the data is stored on the blockchain itself, and that's obviously not very efficient. It requires a lot of bandwidth. In the case of Factom, the checkpoints are made into the Bitcoin blockchain, but those are just hashes, so very little data stored. The data that Factom stores, I think most of it's stored on the blockchain itself. Other projects have used other techniques. So one common of them is to use some form of BitTorrent or IPFS or external replicated database to store the data. In Ethereum, for example, a very popular method has become the use of Swarm, which is kind of like an IPFS built on Ethereum. The second question is, recently, blockchain and healthcare seems to be new hype. People encrypt their medical records with their own private key, and then the nodes store all the data. Even ignoring the efficiency problems, what happens if I'm in a coma and the hospital wants to see my medical records? I can't give the doctor the password because I'm in a coma. Roland, I have to tell you that the applications of blockchain in healthcare are probably the most hype-filled applications I've ever seen. I am still not persuaded that there are useful applications for blockchain technology in healthcare. There might be some useful applications in tracking the provenance of pharmaceuticals to make sure that they're not counterfeit. That's a very limited scope application that would really only be applicable in very affluent countries where the problem isn't that big. In the idea of putting your medical records on a blockchain, why? Why would you do that? Essentially, what you're saying is you're using the word blockchain in place of the word database. And anytime you can take the brochure, prospectus, or mission statement of one of these blockchain companies, replace every instance of the word blockchain with database, and it still makes sense, that means they're not building a blockchain. They're building a database, and they're calling it a blockchain so they can get more funding. What the hell is the point of putting medical records on a blockchain? Are you taking advantage of the censorship resistance? Has anyone ever stopped you from giving them your medical records? Quite the opposite. The biggest problem is keeping them private. Are you taking advantage of the neutrality of the validation of the consensus rules? Not really. Are you taking advantage of the replication? BitTorrent might be a better solution than that, as are many other options, and you can do replicated databases. Are you taking advantage of the fact that it's borderless? Well, in most cases, there are much bigger issues introducing borders in healthcare than the availability of the medical records. That's the easiest thing to transfer across borders. So, in all of this, you have to ask, what does a blockchain give you? And I don't think healthcare is a very good application. As you said, if you put your medical records online on a blockchain, you're either making them public, which is a very bad idea, or you're encrypting them, which then exposes you to the risk of losing your key, revealing your key, and having your medical records compromised. Like if that key gets revealed at any point in time in the future, all of your medical records can then be decrypted. So that's a terrible idea. I certainly wouldn't put my medical records on a blockchain. Just because we have blockchains doesn't mean we have to use them everywhere. Jean-Marc Bernard asks, hey Andreas, I had a look at the estate planning of Third Key Solutions. It seems to me that the wills this company handles are only for the digital assets, crypto assets. An easy online Bitcoin application to make wills would be interesting. As soon as the death would be declared by the doctor, a Bitcoin application could send multi-sig to the heirs and inheritance tax records. That's an interesting idea, Jean-Marc. First of all, a quick disclosure. I'm acting as the Chief Technology Officer for Third Key Solutions. So I'm involved in this project. There's a reason why when we work in this space and do estate planning, we focus on the digital assets only. And that is because the main purpose is to coordinate with an existing estate plan and attorneys who execute that estate plan. Estate planning, if you like, with digital assets, is 50% technology, 50% law. And if you don't do the technology, then the law is useless because you can't get access to the assets. And if you do the technology and you don't do the law, then you can run into significant problems because what you do technically may not be legal, may not be recognized by law. So you can transfer your crypto assets through a multi-sig to your cousin Cletus, and then the rest of your family sues to take the money away from Cletus because it wasn't binding in the state that you are. So that's a discrepancy between technology and law. Making an online application to make wills, interesting, but not possible yet, and for a number of reasons. The first reason is that estate law is different in every jurisdiction. And that's not just 194 countries. In the United States, for example, estate law is handled at a state level, which means that there are 50 different laws. Estate lawyers are specialists. They don't just specialize in estate law. They specialize in estate law in the state of New Jersey or estate law in the state of Florida. You will rarely find estate lawyers who do more than one state. And they are usually run by teams, and they coordinate with lawyers from multiple states if they have to. So that's just the United States. And you can imagine that estate laws in every country are different. They have different rules about what rights spouses have, about how you can execute what is a legal will, what is accepted as a will. And so making a Bitcoin application that simply transfers money to the heirs, while appealing in theory, would create a lot of legal headaches for your heirs. So when dealing with estate planning, what I found, and what is also applied at Third Key Solutions, is that the best way to do this is to do a combination of technology and law. We would work with the lawyers who manage estate planning in the specific jurisdiction that the person lives, or that their heirs live, or however they've arranged it, and at the same time combine that with technology. The difficult part isn't the technology. Although the lawyers don't really understand cryptos and they need to do something, the really difficult part is dealing with the jurisdiction. So one more question. Can you clarify how tagging-based coloring algorithms works for colored coins? Maybe you can give an example to make the concept more concrete. Um, the coloring algorithm works by introducing into a transaction an output whose meaning is interpreted by the protocol. For example, let's say you're using the open assets protocol for colored coins. In the case of open assets, you would first issue an asset. There are usually two types of transactions. There's transactions that issue assets, and then there's transactions that simply transfer assets from one owner to another. When you issue assets, you take a small amount of Bitcoin, which is used to pay for fees, and as well to create the smallest output you can create, usually just a few thousand Satoshis. And then you create a number of assets, which are outputs in the transaction. And one special output that tells you what the other outputs are. So for example, you might have the first output be encoded as an op return code, which contains data. Part of that data would identify it as an open assets transaction. In fact, if you look at the transactions that are involved in open assets, the op return starts with OA, which means open assets. The first two characters are OA. So that identifies that op return as belonging to an open assets instruction. That's followed by a number of opcodes that tell it what kind of transaction this is. Maybe it's an issuance transaction, and then tell the system what the other outputs in that transaction are. So it might say the first output is issuing an asset called oranges. There will only ever be 10,000 oranges. They cannot be subdivided. And here's a link to additional information, metadata about the asset oranges, who owns it, what it looks like, et cetera, et cetera. Then in a transfer transaction, it might have an op return output in the beginning that has OA as the first two characters that mean open assets, and then an opcode that says the first output transfers so many of these oranges to this person, to this output, this address, and the second output transfers this many oranges, or whatever. And so that way, the information about what these outputs are and how to interpret them in terms of the assets that the colored coins represent is recorded in op return data outputs, usually, that record this metadata. They may have links to external sites and other information. That's how Colu works. That's how Counterparty works. That's how Omni works. That's how open assets work. They all use op return codes to signal to tell you what the other outputs in the transaction are. What is the difference between sidechains and Lightning Network? That's a great question. So a sidechain is a full blockchain that operates in parallel to Bitcoin, that may have its own mining rules. It might be an altcoin, another cryptocurrency. So for example, you could have Bitcoin and Ethereum acting as sidechains to each other. In that case, what you're doing is you're creating a way to link two blockchains and transfer assets from one to the other through transactions. So you can say, in this Bitcoin transaction, I'm sending, but not to a Bitcoin address. I'm doing a cross-chain transfer that goes into the Ethereum chain, and that's going to free up some ether in the other chain corresponding to this Bitcoin. So you lock up coins in one chain and free up coins in the other to do a cross-chain swap, if you like. And then you can go the other way. So that's a double-sided sidechain, or two-way peg, as it's called. In order to implement those, you need some changes to the scripting language, and probably some malleability fixes with SegWit. So that's sidechains. Lightning Network isn't a separate blockchain. Lightning Network is a protocol for exchanging signed Bitcoin transactions that represent the balance of a payment channel. So for example, let's say I open a payment channel with you, and I currently owe you 2 Bitcoin and you owe me 1 Bitcoin, and that's the current balance or state of the channel. So we would sign transactions that would settle that balance. So sign a transaction from our common multisig, which is usually how it's based. Lightning Network and other payment channels work usually with multisig, not always. And we would sign and say, okay, we're both going to sign from the multisig and give a refund of 2 Bitcoin to me and 1 Bitcoin to you, and that's the refund. But don't cash it yet. We'll just hold it. That way we know that if either of us disappears, we don't have to trust each other. We can just take the transaction we have, put it on the Bitcoin network, and then I will get my 2 Bitcoin, you'll get your 1 Bitcoin. Channel is done. Now, let's say I want to pay you a Bitcoin in the channel. Well, now my balance will change from 2 Bitcoin to 1, and yours will change from 1 to 2. So we've modified the internal state of the channel. Rather than making that transaction on Bitcoin, all we do, again, is exchange signed transactions. We sign a transaction from the multisig that gives me a refund of 1 and you a refund of 2. Now we know that if either of us disconnects, we can cash these transactions in, and it will settle the balance of the channel. We also exchange some secret keys to invalidate the previous transactions so that we can't go back on our promises. And we keep doing that. We're just exchanging signed, fully valid Bitcoin transactions that represent the current state of the network. We're doing that, exchanging these transactions, these signed valid transactions, between the two of us without committing that onto Bitcoin. So Lightning Network is Bitcoin transactions. It's just Bitcoin transactions swapped very, very quickly by two parties in a closed system where they hold, at any point in time, they hold a valid transaction that they can redeem on the network, but they don't redeem. They just keep exchanging these transactions and keep the channel open. Similarly, with Lightning Network, you can extend that further. So if you have multiple channels to multiple people, Alice has a channel to Bob, Bob has a channel to Carol, Carol has a channel to David, and Alice wants to pay David. So Alice can make a promise to Bob, Bob can make a promise to Carol, Carol can make a promise to David, and then David can cash the promise from Carol so that Carol can cash the promise from Bob, and Bob can cash the promise from Alice, all by redeeming these transactions on their own balance, on their own channels. And that way you can essentially tie channels together, and Alice can make a payment directly to David without having a channel with David. Alice just pays Bob, but on the understanding that Bob will pay Carol and Carol will pay David. And that way you can do chained together channels. So Lightning Network is exchanging transactions within a protocol that runs on the internet. These are Bitcoin transactions. They're signed Bitcoin transactions, but they're never submitted to the blockchain unless there's a problem. Only when you close the channel do you submit a transaction. You submit one to open it and 1 or 2 transactions to close it. All right, and that covers the difference between sidechains and Lightning Network. Let's see if we have any live questions from the audience. If not, this is going to be a short session. Let's see. Any live questions from the audience? Okay, that looks like it's it. No live questions from the audience. And, oh, yeah, we have one last-minute question. Here we go. So the question here is, as far as I understand, sidechains require a hard fork to be performed in the Bitcoin network in order to work and to be activated. Please correct me if I'm wrong with this. Actually, no, they don't. You could activate sidechains with a soft fork. In order to introduce some Bitcoin script opcodes that allow you to do two-way pegs, specifically that allow you to offer an SPV proof from another chain that can be validated on the Bitcoin blockchain to transfer coins back into Bitcoin. That opcode that needs to be added can be added by soft fork. It can be added by soft fork replacing an existing opcode, or it can be added by a script version upgrade in SegWit, segregated witness, as a soft fork. It does not require a hard fork at all. It doesn't change the consensus rules. It only tightens them. It doesn't make them incompatible with old clients. So sidechains can be created by soft fork. Let's see if we have any other questions from the audience. Give it just a second. It takes a few seconds for the audience questions to filter through from the YouTube channel to my Q&A panel here, and I want to make sure I don't cut off just before someone asks the questions. Taking this into account, I'm assuming that means the hard fork, soft fork for activating sidechains. Is it necessary to let Bitcoin Unlimited be activated or similar client? Why does the Bitcoin Core team like to use SegWit? Bitcoin Unlimited represents a change that would require a hard fork. The Bitcoin Core team would prefer to use a soft fork because they and many other experts consider it the safer option. A soft fork doesn't require all clients to upgrade and doesn't create an incompatibility in the network. Hard forks, even if they're agreed on by the majority of the participants in the network, can be dangerous in some ways. They can lead to a split where you have the emergence of two competing chains that are incompatible, which can cause all kinds of other problems, including replay attacks, fragmentation of the ecosystem, confusion for developers, investors, etc. So there is no requirement to do a hard fork for many of the features that are needed for upgrades. And therefore, Bitcoin Core would prefer to do a soft fork to SegWit, which is a feature that has now been developed and tested for more than a year, probably the most well-tested software in Bitcoin's history. And that seems to be the best candidate, both for scaling, but more importantly, for fixing a number of issues, including transaction malleability and quadratic hashing performance, that will allow a number of new technologies to be built in Bitcoin, including Lightning Network and a few other things. Schnorr signatures for aggregation, confidential transactions, and many other things that currently depend on a fix for malleability. SegWit also increases the block size effectively to 2 to 2.1 meg, depending on what transactions are included. So it provides scaling on-chain for almost double the number of transactions to be processed. Bitcoin Unlimited, by comparison, while it gives miners complete control over setting the block size, which may be dangerous for the formation of a cartel and for anti-competitive behavior among miners, it also doesn't fix transaction malleability. It does not include SegWit, and it does not allow for any of the other technologies to be built on top. So that's one of the reasons why there's a big debate. And it is my opinion that SegWit is the better solution. And in fact, of all of the scaling solutions we've seen, from XT to Classic to Unlimited today to the various proposals, BIP 101, BIP 102, Bitcoin Unlimited is probably the least tested, the most dangerous, and the most radical change in the consensus algorithms. I think the biggest problem is that it gives miners complete control over setting the block size, which in itself would allow very well-funded large miners through a set of successive rounds of block size increases to price out any small miner. Just like Walmart in the United States can deliver such low prices that they put every local business out of business when they open a store, quite on purpose, and they drive prices as low as possible and even operate at a loss for an extended period of time in order to drive competition out of business. a mining group that has the ability through Bitcoin Unlimited and a significant percentage of the hash power to set the block size can gradually peel off in 5% increments its competition until no one is able to continue operating and can gain cartel control. How would we handle a hard fork split on a sidechain? That's a great question. I have no idea. I haven't actually considered how you would coordinate two sidechains if one of them has a hard fork. Presumably, you'd be able to move from the two competing sides of the sidechain to the other sidechain, but confusing. How can Bitcoin users contribute to the dialogue and promote Bitcoin growth through the noise? Don't buy into the drama. Don't feed the drama. The bottom line is that these are complex technical decisions and trade-offs, and most of the conversation is political and emotional in nature and has nothing to do with the technical choices. And so the best response is to not listen to the crazy propaganda, drama, and emotional responses you get from both sides of this argument. This is not a discussion about choosing which is the best football team or picking your religion. It's a technical decision, and there are no perfect answers. There are trade-offs involved in everything. And so I think a lot of the drama you just have to ignore. I think with that, we've got a good set of questions for this session. Let's wrap it up. Thank you all for participating. This was session 6, Alternative Uses of the Blockchain, of the massive open online course for the University of Nicosia's Masters in Digital Currencies. I'm Andreas Antonopoulos. I've been answering your questions for this session, and I'll see you soon. On the next session in 1 week, we're going to be talking about altcoins and the broader space of cryptocurrencies beyond Bitcoin.